Hello and welcome to this video. In this video, we are going to do a A-level question from paper 4, Feb-March 2024, question 1. The question states that RPPLC uses investment appraisal techniques in determining whether or not to undertake specific projects. In the A bit of the question, we are asked to explain why non-financial factors are disregarded by traditional investment appraisal techniques. You see, when we talk about the investment appraisal techniques, we talk about the cash flows, that is cash inflows, cash outflows and the net cash flows, and on that basis we try to analyze or appraise the investments, and this is based on the monetary analysis, and non-financial factors cannot be expressed in monetary terms. Hence the non-financial factors are disregarded when we go for investment appraisals based on traditional investment appraisal techniques. In the B bit of the question, we are asked to suggest two non-financial factors which are disregarded by traditional investment appraisal techniques. Let us understand the non-financial factors which may not be regarded by traditional investment appraisal technique by means of an example. Say RPLC have purchased an automated machinery for manufacturing for a specific project. The non-financial factors which may not be considered will be the improvement in the staff morale, like the new machinery may require new skills and adaptation to new production methods which require training and change. However, employees usually resist change and which may lead to demotivation, which may not be regarded by means of traditional investment appraisal technique. Next, the purchase of automated machinery can lead to improvement in customer satisfaction, as automated production leads to high quality products at low price, yet it is a non-financial factor, hence not regarded by means of traditional investment appraisal technique. The effect on environment because of the automated machinery which have been used for production may lead to decrease in pollution or increase in pollution, again as this is a non-financial factor, hence it is not considered by means of traditional investment appraisal technique. Furthermore, the competitive advantage because high quality product at low price will lead to competitive advantage, again this is not considered when we go for traditional investment appraisal technique. Furthermore, the automation may lead to job losses, and this may also have an adverse effect on the social welfare of the employees, as this is again a non-financial factor, hence this is also not regarded by the traditional investment appraisal techniques. So these are the few suggestions or examples of non-financial factors which are not regarded when we go for traditional investment appraisal technique. Furthermore, additional information is provided which states that the directors of RPLC are considering paying $100,000 to acquire a license. This would give the company the right to manufacture and sell the product for next 4 years. The following budgeted information is also available. So the budgeted information which is given is: year 1, units produced and sold was 6,000, selling price per unit was $19, variable cost per unit was $11. Year 2, units produced and sold was 10,000 and the selling price per unit was $22. The variable cost per unit was $11. Then year 3, we have units produced and sold as 8,000 and then selling price per unit was $18. Variable cost per unit was $13. Year 4, we have units produced and sold 4,000. The selling price per unit is $15 and the variable cost per unit is $14. The fixed cost excluding amortization or depreciation are expected to amount to $19,000 per annum. In the C bit of the question, we are asked to calculate the net cash flow expected to arise in each of the year 1 to 4. So let's start with our working notes. We will start with the sales. For sales, we have the units produced and sold and the selling price. So when we multiply this, that is $19 times 6,000. We'll get the sales for year 1 as $114,000. The variable cost will be $11 times 6,000, which will be $66,000 for year 1. Then in the same way for year 2, it will be $22 times 10,000, which will be $220,000 for sales, and for variable cost it will be 11 times 10,000, which will be $110,000. For year 3 it will be 18 times 8,000, which will be $144,000, and for variable cost it will be 13 times 8,000, which will be $104,000. For year 4 the sales will be 15 times 4,000, which will be $60,000, and the variable cost will be 14 times 4,000, which will be $56,000. Now let's calculate the net cash flow. We'll start with the year 1. We have calculated the sales as $114,000, and from there we subtract the variable cost, which we have calculated as $66,000, and the fixed cost, which was given as $19,000. So we get the net cash flow as $29,000. In year 2 we have the sales as $220,000, and the variable cost, which we calculated, was $110,000, and the fixed cost, which was given, was $19,000. So when we subtract the variable cost and the fixed cost from the sales, we get the net cash flow as $91,000. In the year 3 we have sales as $144,000. From there we subtract the variable cost, which we have calculated as $104,000, and the fixed cost, which was given, was $19,000. So we get the net cash flow as $21,000. In year 4 the sales, which we have calculated, was $60,000. The variable cost, which we calculated, was $56,000, which we subtract, and the fixed cost, which was given, was $19,000. Again, when we subtract this from the sales, we get the net cash flow as negative $15,000. Furthermore, additional information is given, which states that discount factors are as follows: year 10% and 15%. Year 1 it is 0.909 and 0.870. Year 2 it is 0.826 and 0.756. Year 3 it is 0.751 and 0.658. Year 4 it is 0.683 and 0.572. In the debate of the question, we are asked to calculate to 2 decimal places the internal rate of return, which is IRR, of the purchases of the license. For IRR, we start with calculating the net present value at the given discount rate, which was 10% and 15%. So we'll start with that. In the year 0, that is in the initial year, we have to purchase the license, and the value was $100,000, and as this is an outflow of cash, it will be negative, which we have mentioned here. Then in the year 1, the net cash flow, which we calculated, was $29,000, and for the first year at 10% discount rate, the value which was given was 0.909. So when we multiply 29,000 with 0.909, we get the value as $26,361. And in the same way, for 15% discount rate, the value for first year which was given was 0.870. So 29,000 times 0.870 will be $25,230. Then in the year 2, we have calculated the net cash flow as $91,000. And again, the discounting factor at 10% was given for the second year was 0.826. So when we multiply 91,000 times 0.826, we get the value as $71,166. And for 15%, the discount factor which was given for year 2 was 0.756. So 91,000 times 0.756 will be $68,796. In the year 3, we have calculated the net cash flow as $21,000, and 10% discount factor which was given for the year 3 was 0.751. So when we multiply this 21,000 times 0.751, we get the present value at 10% as $15,771. And for 15%, the discount factor for the year 3 which was given was 0.658. And when we multiply 21,000 times 0.658, we get the present value at 15% as $13,818. In the year 4, we have calculated the net cash flow as negative $15,000, and the value which was given for 10% discount factor for the year 4 was 0.683. So when we multiply this, we get negative $10,245 for 10%, and then for 15% the discount factor for the year 4 was given was 0.572. So negative 15,000 times 0.572, we get negative $8,580 for the present value at 15%. Now what we do? We take this present value and add and subtract. That is negative 100,000 plus 26,361 plus 75,166 plus 15,771 minus $10,245. So when we do this, we get the net present value for 10% as $7,053. Now the net present value for 15% will be minus 100,000 plus 25,230 plus 68,796 plus 13,818 minus 8,580. We get the net present value at 15% as negative $736. Now we will calculate the internal rate of return IRR by using the formula capital P plus capital N minus capital P times small p divided by small p plus n. Here the capital P is the discount rate which gives us the positive NPV, and in this question we have this as 10%, and the small p will be the net present value which we get as positive net present value, which was $7,053. Then capital N will be the discount rate which gives us the negative NPV, which here we have is 15%, and the small n is the value of the negative NPV which we got as $736. So when we apply this in the formula, it will be 10% plus 15% minus 10% times 7,053 divided by 7,053 plus $736. So we'll get IRR as 14.53%. In the EBIT of the question, we are asked to discuss whether it would be better on financial grounds for the company to stop production at the end of year 3, assuming that the fixed cost and the cost of the license would be unchanged. Calculations are not required. You see, when we have calculated the cash flow in the year 4, we are getting a negative cash flow of $15,000, which shows that there is a loss instead of profit. However, it is not advisable to stop the production after year 3. Why? Because here the fixed cost and the cost of license are not changing, and if we keep the production for the year 4, we still get a positive contribution of $4,000, because here we are paying the fixed cost as $19,000 even if we stop the production, and if we keep the production we will get a net cash flow of $15,000, which is negative, but still it has a positive contribution of $4,000, so they should continue the production till year 4. Furthermore, additional information is given. The IRR arising from the purchase of the license was higher than the company's cost of capital, and so it was decided to go ahead with the purchase. One of the directors thought that the decision was hasty and that other investment appraisals techniques should be used. In the bit of the question, we are asked to advise the directors whether or not other investment appraisal techniques should be used, and we have to justify our answer, and here we don't require any calculations. You see, if they go for other techniques of investment appraisal, apart from IRR, we have payback method. It is a very simple method to calculate, and in this we recognize the sooner we get back the initial investment, the less risky the project is. However, when we go for payback method, we will just try to find out the duration in which we get the initial investment back, that is 100,000 which we are investing for the license. In what duration we are going to get back, we will check it by means of the net cash flow. And if we see based on the calculation which we have done previously, they'll get the initial investment back in 2 years. So what happen is, whatever is the calculation after 2 years will be ignored when we go for payback method. So apart from that, one more drawback which payback method have is it ignores the time value of money. We don't take discounting factor there. So these are the two main drawbacks of payback method. If they don't want to go for the payback method, another technique of calculating investment appraisal is accounting rate of return, which is ARR. You see, the benefit of taking ARR is it takes into consideration all the net cash flows, that is the net cash flows of all the 4 years, same as IRR. However, it has some major drawbacks, that is, in ARR we calculate the average profit taking the net cash flow of all the 4 years. However, profit is subjective in nature, as it will be affected based on the accounting policy which the company takes. Hence, this will be a drawback. Apart from that, the other drawback is it ignores the net present value, same as payback method. So these are the two major drawbacks of ARR. Based on the drawbacks, I suggest that they should still follow the internal rate of return as the technique for investment appraisals. The reason for my suggestion is IRR takes into consideration earning of all the 4 years, as well as it calculates the net present value of the entire project. Hence, this is mostly accepted as well as the most suitable method of investment appraisal. Furthermore, if they go for additional techniques, it will be time consuming and it will also not lead to an accurate outcome. However, they should also highlight the other aspects of decision, particularly with regards to the level of risk. So with this, we have completed this question.
Thanks for watching my videos. Have a peaceful and blessed life.